What are options? Options are financial derivatives that derive their value from an underlying asset, such as a stock, index, commodity, or currency. They are contracts that grant the buyer the right, but not the obligation, to buy or sell the underlying asset at a predetermined price, called the strike price, within a specific time frame. Options play a crucial role in modern financial markets, offering versatility for hedging, speculation, and income generation. Key terms in options trading: call option gives the holder the right to buy the underlying asset at the strike price before the expiration date. Put option gives the holder the right to sell the underlying asset at the strike price before the expiration date. Premium, the price paid by the buyer to the seller, writer, for the options contract. Strike price, the predetermined price at which the option holder can buy or sell the underlying asset. Expiration date, the date on which the options contract becomes void if not exercised. Underlying asset, the security or asset upon which the options contract is based. Options provide flexibility, allowing traders to leverage positions, hedge risks, or profit from various market scenarios. Understanding their mechanics is the first step toward mastering their use. The purpose of options. Hedging is one of the primary purposes of options. By purchasing put options, investors can protect their portfolios from adverse price movements. For example, a stock investor may buy a put option as insurance against a potential decline in the stock's price. Options are powerful tools for speculation due to their leverage. Traders can use call options to bet on a stock's price increase or put options to bet on a decrease. The ability to control a large position with a relatively small premium allows traders to amplify their returns, though it also increases risk. Options can also generate income through strategies like selling covered calls or cash-secured puts. By writing options, traders collect premiums, earning income even in neutral market conditions. Types of options. 1. American options can be exercised at any time before the expiration date. This flexibility makes them popular for stocks and exchange-traded assets in the United States. European options can only be exercised on the expiration date. They are often used in index options and are typically easier to price due to their limited exercise flexibility. Exotic options deviate from standard structures. Examples include barrier options, activated or nullified when the underlying asset reaches a specific price. Asian options use the average price of the underlying asset over a specific period. Binary options pay a fixed amount if a condition is met or nothing if it is not. How options differ from other financial instruments. While stocks represent ownership in a company, options are contracts derived from underlying assets. Stocks have an indefinite lifespan, while options have a finite duration. Options also allow traders to gain exposure to an asset without full ownership. Futures are contractual obligations to buy or sell an asset at a specific price on a future date. Unlike options, futures require the holder to fulfill the contract at expiration. Options provide more flexibility by allowing holders to choose whether to exercise the contract. Options offer significant leverage, enabling traders to control large positions with minimal capital. However, this leverage amplifies both potential gains and losses, making risk management essential. The evolution of options markets. The origins of options can be traced back to ancient Greece, where philosopher Thales used options to secure the rights to olive presses, speculating on a strong harvest. Modern options markets began in 1973 with the establishment of the Chicago Board Options Exchange, CBOE, which standardized options contracts and introduced a regulated marketplace. The Black-Scholes model, introduced in 1973, revolutionized options pricing by providing a mathematical framework for valuing options. This model laid the foundation for advanced derivatives trading. Real-life applications of options. Investors use options to protect their portfolios against significant losses. For instance, buying put options can mitigate risks during market downturns. Options can be employed to boost portfolio returns through strategies like writing covered calls, which generate income from assets already held. Traders leverage options to capitalize on market volatility or directional moves, using calls or puts depending on their market outlook. Institutions use options to implement sophisticated hedging strategies, such as delta hedging, which minimizes risk from price movements of the underlying asset. Common myths about options: options are too risky. While options can be risky, proper education and risk management significantly mitigate these risks. Conservative strategies like covered calls or protective puts align with long-term investment goals. Options are only for professionals. Retail investors can benefit from options with basic strategies. Many brokers offer user-friendly tools and educational resources to help individuals get started. You can lose more than you invest. This is true for specific strategies, like naked option selling, but not for buying options, where the maximum loss is limited to the premium paid. Summary and key takeaways. Options are versatile financial instruments that provide opportunities for hedging, speculation, and income generation. Understanding the key terms, purposes, and types of options is essential for leveraging their potential. With a rich history and numerous applications, options are integral to modern finance, empowering traders and investors to navigate various market conditions. In the next module, we'll explore the basics of options trading, delving into how options contracts work, how to read an options chain, and the fundamentals of pricing. Thanks for watching Module 1. Please like, share and subscribe. See you in the next module.